started unwinding. Well, what does that mean? They started selling dollars, selling US government treasuries, and they were buying the yen. And so they're unwinding all of this. Well, guess what? There are still trillions of dollars to go. And the next move that the Bank of Japan is going to have to make is going to be a rate hike. The next move the US Federal Reserve is going to have to make is going to be a rate cut. And so when this happens, you end up with a self-reinforcing feedback loop. The more people who close out the carry trade, the more strongly the yen will act against the dollar, causing more people to have to unwind the carry trade. So as people unwind, it causes more people to unwind. It's a self-reinforcing feedback loop. That's where we are right now.
Welcome to the Row Show podcast. Welcome to the Row Show. Today I'm here with Gary Brode. He has over 30 years in the securities industry. He's the founder of Deep Knowledge Investing. It's an investment research firm with focus on identifying and analyzing those aspects of selected investments that the market is missing. He's a hedge fund turned to the good side. So how you doing, Gary?
Hey, Ro, thanks for having me. I appreciate the invitation.
Oh, absolutely. We're so grateful to have you here today. So let's talk about this good side. So it seems like the other side is not as good. Tell us about that.
So, that's a little bit of marketing talk there. I'm not one of those people who actually believes that, hedge fund managers are, the evil guys wearing cloaks in the back room, plotting to ruin the world. Um, I've known a lot of people in the business over the last 3.5 decades, and the truth is they're like everybody else. Most of them are smart, driven, care a lot about their clients and want to help them make money. Of course, there are some people who have earned maybe some bad reputational. Um, uh, it's an industry with a rough reputation, but I think most people it's like every business. Any business you go into, you'll find a lot of people who have great intentions and who work really hard, and then a few people who sort of set the stereotype. So that tagline of we've turned to the good side, it's really more marketing than reality. I don't think people in the hedge fund business are bad people.
It's a great marketing line, but I think what goes a little deeper, and you make this point, you make a distinction between the sell side and the buy side. And I think that's really more of the focus here, since traditional sell side research is not really designed to make the investor money.
That's
It
right.
is designed to market investment banking services to the companies they cover. So you actually do the opposite, which I want to know more about. So if you could tell us about what you do on your side, the buy side versus the sell side, I think that would shed some light here.
Yeah, so thanks, Ro. It's a great question, and it's a really important one because for people who have been in the industry like you and I have for a long time, it's an open secret. We all know this. But for people who are coming from outside, they may not know. So let's just take a minute and talk about how sell side research works. There are plenty of times I talk to someone and they say, "Why should I pay for research? I already get research for free." Okay, but are you getting research for free? And so here's what will typically happen. You have one of the big investment banks, maybe, Morgan Stanley, Goldman Sachs, JP Morgan, Citi, and, they produce research and they give it away. Why are they doing that? Right? Is there a reason? Of course there is. So what will happen is that that investment bank will pick up a company for coverage and they will say, okay, we're going to cover Google or Tesla or Amazon. And, they have an analyst who follows the company and publishes reports. And, take a look. There's a reason why 95% of those recommendations are buy recommendations. There's a reason why sell recommendations are very, very rare, like 1%. I don't know, Ro, you want to project out a year from now, 2 years from now, you think 99% of stocks aren't going to be down? So what's going on? Right. And it's not, these are not dumb people, right? The sell side, they're analysts, they're working very hard, but what's happening? And what they're doing is they have to stay in the good graces of the management teams of the companies that they cover. because one, they want their business, if there's a debt offering, an equity offering, M&A, if there's an advisory transaction to be made. So basically what these sell side analysts are doing is they're giving away the research as a loss leader to market their investment banking services. And one of the ways we see that play out is the sell side tends to be backwards looking. And what I mean by that is, take a look. You'll see that after the company they cover beats earnings estimates and raises guidance, then they all raise their numbers. And after the company stock price goes past their target price, they raise their target price. And then if it goes the other way, if these companies were to miss and lower guidance, the analysts then after that lower their estimates and take down their price targets, but they keep the buy rating. And so the name of the game is to always be, right in that sweet spot of, not so exposed, but positive. You always want to keep that buy rating. And, people say, well, great, I'm getting research. No, you're not. You're getting marketing materials. And so that these sell side investment banking firms can sell their services to the companies that they cover. It is not the most honest or cleanest way to run your business. And the reason it works for people like you and I is because we know, right? It's sort of this open secret. We know this is how it works. And so we take all sell side research with a grain of salt. And I typically don't read it. On the rare occasions when I read it, it's because, I want their description of what's happening, but not necessarily their analysis, right? They'll be good at saying, the company had a good quarter in this division, a bad quarter in this division, unit sales did this, pricing did that. They're good at that. But you don't want their estimates. You don't want their price targets. You certainly don't want to invest based on that because they're not trying to help you make money. And so, I would just suggest for, people listening to this, be aware of what the incentives are. And, there's this old saying, if you're not paying, if you're getting it for free, then you're the product. Well, that applies to Wall Street as well. So what happens on the buy side is a little bit different. And the way I run my firm is we are conflict free. I do not ask for any money from the companies that I cover. If they were to offer it, I would not accept it. We don't take money from the companies that we cover. I wake up every day. I have one goal, one mission. That is to help deep knowledge investing subscribers, clients, partners make better returns. All I care about is helping you make more money. And that's it. And I frequently will write or say things that certain companies like and they're happy. And guess what? I just as frequently say things that these companies don't like. I once got an angry letter from CBS telling me I'd created considerable consternation in the executive suite. My dad said, wait, are they going to sue you? I'm like, I can only hope so because the publicity would be fantastic. But the point of all this is it's not my job to keep those companies happy. It is my job to help my people, the people who want to do business with deep knowledge investing, make more money and make better returns. And so when I say we are conflict free, that's what I'm talking about, right? The people who are paying me are the people who get my performance.
I understand how you've turned to the good side. You help the people. We want unbiased points of view and analysis. And I always say only the cheese in a mousetrap is free. So even though
Yeah,
you think you're getting stuff for free, you're actually not. It has its own agenda. And, I'm just going to say, don't believe analysts. I know my audience knows that already. And be very cautious when you read those reports. And there's a lot of anchoring that goes on with these price targets and the way their reports are framed. I like those, we lower the price to this, but we still keep a buy. Or,
right,
we're going to lower it to a neutral, but we raise the price target. It's like, which one is it? It's
right.
very confusing, very conflicting. And, you said they're competent people, they're smart people, they know what they're doing. But it sounds like we're talking about the Fed now, but they have their own agenda and they need to support the industry and their companies. So we appreciate you being able to give this unbiased, independent analysis.
In other aspects of our life, we understand these conflicts. So let me give you an example. Let's say you want to buy a used car. You go to the used car lot. You talk to the salesperson. The salesperson's very nice, very personable. He's happy to see you, takes you around and explains the difference between this model and that model and what's in good condition. And now let me ask you a question, Ro. Does anybody believe that salesperson is being so kind and so helpful because they care about you? No, we all understand that salesperson is trying to separate you from the most amount of money that they can get from you. And we accept that. We accept that conflict, that the person who's helping us, right, is also the person who wants to take as much of our money as possible. And so we walk in forewarned, forearmed, right? And where people will understand that in their daily life, it's not always so obvious to retail investors when they're talking to, or looking at research from one of these big firms, right? And to me, the key thing is you have to know where the information is coming from, what their incentives are, and then be able to sort it out yourself. And so, as I know how much you love tangents, but one great example, as we saw a couple weeks ago, the SEC brought a suit against Andrew Left at Citron. Now, I don't know Andrew personally. I have not read the SEC suit. I'm not an attorney. I don't have an opinion on this. But what was alleged was that Andrew was taking certain positions and then issuing research reports to support those positions. And when the research report moved the stock, he'd cash in on quick profits. And so, the SEC now needs to prove that either he was trying to manipulate the market or that he was lying. And then Edwin Dorsey from the Bear Cave wrote a fantastic defense of Andrew Left, saying, hey, this is not illegal. This is not wrong. He's entitled to have a point of view. He's entitled to have a point of view and discuss it. And he's entitled to be wrong, as are we all. So what's illegal here? And that was, I'm summarizing. Edwin wrote a lengthy, really detailed, well thought out piece. I'm summarizing it in, 2 sentences. So, but here's the key thing. When somebody is writing a piece of investment research, you can figure out, what are their incentives? Are they to help you or to help somebody else? How are they getting paid? Is their work good? Is it bad? Are they right? Are they wrong? Right? And you have to think about all that. And ultimately, there's really only one way to protect yourself, and that's to do the work yourself. Right? Or you get somebody like you or me, like sharp pencil people who spend all day looking at these things, and this is what we do. And so when I read this stuff, I don't worry so much about whether Andrew Left or this person or that researcher has a position. I don't worry so much about their incentives. I just try to figure out if they're right or wrong. And I'm looking at the fundamentals of the company. And so that's really your safe harbor. And the really hard thing about it is, you're capable of doing that work. That's the work that I do all day, every day. But if you're a retail investor, one, they don't necessarily have decades of experience. And two, who has time? Right? We're doing this all day. But for people who are working 40, 50, 60 hours a week, maybe they need a little time to take care of their home, to nurture relationships, to take care of their kids. Who has time to do that? And so, you need to find people who you can trust, who are capable of doing that work and sorting out the reality and what's likely to come next from the narrative, from the things that people are talking about in the media or on Twitter. You need to figure out where the narrative is right or wrong.
Absolutely. There are a lot of motivations there that aren't unfortunately in other people's best interest, and the independent point of view, the unbiased, is so important. Plus, there's been a rise in self-directed investing in recent years. So people are needing information and they are busy. Time is the most valuable commodity. And that's the one thing it can't be replaced. So where's the time? So, and it's so easy just to read the reports. You go and you read Morningstar, or you read,
Yeah.
the analyst reports through Business Wire or anywhere, Market Wire, any of these companies, any of these sites. And so they sway us. So it's important to know that they have their own hidden agenda. And that's why I want to go beyond all the analysts today. And we're going to go deep dive on this buy side. And I want to know, Gary, how you have an amazing board. I have to mention that you have a very diverse board of advisors at DKI and all across the spectrum. So you have biotech, you have Bitcoin, economics, foreign policy, real estate, energy. You touch upon all the different areas, and my favorite, decision sciences, which right there is all about cognitive and biases and heuristics, which are very common in trading, especially loss aversion. So with your board, how do you analyze and assess investments? You mentioned fundamental analysis, your time frame, your view. Is it more of a contrarian view? Do you use technical analysis or trend following, and your long short equity investing?
Sure. So how about, why don't we go through two examples
Okay,
of where I work directly with members of the Deep Knowledge Investing Board of Advisors and where they were instrumental in helping us get
perfect. We learn by
our,
example best, I
yeah,
think.
right. And plus, who, you'd much rather hear a story than a dry recitation of investment philosophy, right?
Mhm.
So, how about if I walk you through two stories
Great.
where they added a ton of value? So, first, let's go back to the summer of 2020. Okay. These were the times when we still had a huge amount of COVID related fear. People were locked down. And if you remember, no one wanted to go to the hospital. People were afraid if you went to the hospital that you were going to get COVID and die. And so we had huge amounts of delayed care. People just did not want to go to the hospital. And I understand that. They delayed everything they could. And so there was fear. This is in the summer of 2020 that our hospitals were going to go out of business. And so I was looking at HCA, which I thought was the best run hospital company in the country and, certainly one of the largest. And I drew two conclusions. One, the government had sent them $6 billion because the government did not want our hospitals going out of business. We can understand that. Now, before anyone gets upset about the bailout, to HCA's credit, a quarter later, everything was under control. They sent the $6 billion back. The government didn't even ask. They just said, we don't need this. It's all under control. They sent the money back. So good for them. Um, but the other thing is, like, everybody gets caught up in emotion. But here's the rational thinking that we were doing, which is, okay, we understand that COVID might be, could be, remember, this is at a point when we didn't know, a serious medical problem. But the idea that we were going to shut down 100% of our high end medical treatment facilities in this country, and they were going to be all COVID all the time, that makes no sense. People need joint replacements. They have heart problems. People unfortunately get cancer. People go to the hospital for reasons way beyond COVID. And the idea that everything was going to shut down because of COVID was just kind of a silly idea, right? Again, if you had cancer or a heart attack, you were going to the hospital and needed that care. So with all of that in mind and these stocks trading like they were going to go out of business, the summer of 2020, I started buying HCA in like the 120s, 130s. Then what happened was a couple of months later, then Justice Ruth Bader Ginsburg, who was Justice of the Supreme Court, died. And there were fears that President Trump would replace Justice Ginsburg. The fear at the time was that he would replace her with now Justice Amy Barrett Cohen. And there was a case in front of the Supreme Court called California versus Texas. And had that decision gone a certain way, it would have invalidated the Affordable Care Act, which people know as Obamacare. And that would have been a problem for the hospital. So people said, oh my God, right? The Affordable Care Act is going to be overturned and the Supreme Court's going to, reverse this ruling. And again, the hospitals are all going to have huge problems. And that sent the stock down to 115. Fortunately, one of the people on my board of advisors, Phil Kessler, knows most of the members of the United States Supreme Court personally. He's had drinks with them. He's had dinner with them. He's had a chance to sit and speak with them. So we started going through the court one person at a time. And he said, well, Roberts thinks about things this way and Thomas thinks this way. And, literally just going through the entire court, and Justice Breyer thinks like this. And when we did the math, what we realized was with or without now Justice Amy Barrett Cohen, there were at least 5 votes to maintain the status quo. And at that point, we backed up the truck. At 115 in September of 2020, we bought a huge amount of HCA. because we understood that people were afraid of something that wasn't going to happen. And then what ended up happening was the hospitals did not go out of business. People started returning to the hospitals for high margin elective procedures. The Texas versus California case was decided in the way that we thought it would be, which was to maintain the status quo and keep Obamacare or the ACA. And the following summer, the following July, I think, June or July, we sold that stock for $250. So we made more than 100% of our money on this for our subscribers, our partners, our clients. But one of the reasons we were able to do that was because I had someone on the board of advisors who literally knew almost every member of the Supreme Court personally. And so we were able to use a combination of common sense, financial analysis, and legal analysis to come to the right conclusion and realize, again, the dominant narrative was wrong and the returns there were more than 100%. Going on to a second example, we have one really recently. Another member of the Deep Knowledge Investing Board of Advisors, Dr. Paul Thompson. He's a cardiologist and he is one of the country's top exercise cardiologists. He finished, I think, in the top 20 in the Boston Marathon years ago. Like, what this guy doesn't know about heart health is a very small thing. And so he contacted me. In the fourth quarter of last year, the fourth quarter of 23. And he said to me, you know, there's this company called Shockwave Medical, and they make this device that enables the safe placement of stents in situations where there's excessive calcification. Now, that's just a fancy way of saying the heart artery would have so much plaque in it that it would become brittle and blocked, and it was hard to place a normal stent. Um, and Shockwave had this technology that allowed placement of those stents, and it was much safer than the current standard of care in those difficult cases, which was called a rotablator, which is basically a blender on a wire. And it's not that the rotablator doesn't work, it's that if the interventional cardiologist, the surgeon performing that procedure, slips just a tiny bit and nicks the artery, your patient can bleed out on the table in minutes. It's dangerous. Look, it's most of them do it very successfully, but it's not the safest procedure and it's not what they want to be doing. And here with Shockwave, by doing this with electrical pulses, it was a much better procedure. And Dr. Thompson put me in touch with Dr. Dan Fram, an interventional cardiologist. And I started to do a whole bunch of other research calls. And I started speaking with cardiologists and interventional cardiologists. And what we realized was there is no competition, right? You have regular stents, which are great for about 80% of cases. You have the rotablator, which was what was used in the other 10 to 20% of cases. And Shockwave was just so much better. To make things even better, the company had rejected a takeover offer by Boston Scientific earlier that year on price. And the stock had, again, because they rejected the deal, gotten hammered. And so Deep Knowledge Investing subscribers, we were buying this stock at 191 in December of 23. And my thesis was this company will be bought for somewhere between $300 and $350 by either Johnson & Johnson, Medtronic, or Boston Scientific. Well, 3.5 months later, it was Johnson & Johnson for $335 in cash, right in the sweet spot of the range we talked about. And Deep Knowledge Investing subscribers and clients made more than 70% of their money in under 4 months. And the reason we were able to do that is because we had people around who understood the cardiology market, doctors who understood the interventional cardiology market, people who use these devices, who perform these procedures dozens and dozens of times a day. This is all they do all day. Having that kind of advanced understanding and having people on my board who care and who work with me on these ideas it's a huge advantage, and it's helped us make outsized returns. And I will tell you, I am right now in the final stages of editing the research piece on our latest idea, which is a drug company in, unsurprisingly, the cardiology market. And so, again, talking with Dr. Paul Thompson and Dr. Dan Fram, the same guys came to me and said, hey, you should check this out. This drug is better than what people are using. And again, I've, spoken with other cardiologists and realized not only are they right, there's no competition. And this is basically a public venture capital company where they just got approval, revenues are starting to ramp, and the stock is insanely cheap. So, that report will be available to DKI subscribers in the next week or two. And so, here's a case where the same people who helped us make outsized returns in one cardiology, that was a device company. This is a combination drug and device company. But there's a reason we're going back to the well on this one. And so our subscribers will have that report, like I said, in the next week or two. But I think it's the kind of thing where there's the opportunity to make maybe 4 to 5 times your money over, maybe a 3, 4 year period.
Exciting. It's having that knowledge, these experts in their fields, and being able to pool all that insight together and then present it in an independent way is key there. Now, on your Twitter or X profile banner,
Yeah.
you have DKI and you have what we're investing next. So I want to ask you, whatever you can tell us, what are you investing in next? What are you looking at? Just, either sectors or any particular stocks that you can share that DKI is targeting.
So the next two things we're doing are in the healthcare space. These are small cap companies. One is the drug company we were just talking about. The other is a semi-private, soon to be public company that does specialty insurance. I can't talk about that one right now because I've signed an NDA. We will soon be able to talk about it, but at the moment, I need to honor that NDA and not talk about it. The other drug company, that one definitely has my attention. I've been buying it this week. I was buying it last week. We're not ready to talk about that in public. That one we're saving for our paying subscribers. There's a reason they're paying. I think they might be a little annoyed if I were giving that out.
Sure.
That said, right now I'm both heavily invested and heavily hedged. I'm finding opportunities that I like. One of the things, and it's been a controversial stock, I think Las Vegas Sands is really interesting. There's a lot of concern about the Chinese market, except the gaming numbers from Macau continue to get better. The recovery there is terrific. There's also a misunderstanding there. A lot of people are worried. They look at the GGR, which is gross gaming revenue. That's just a fancy way of saying how much money is gambled at the tables, right? And so those numbers are down, and people are saying, oh my God, there must be a problem. There's no problem, bro. What's happening is the mass and premium mass markets have come back. They're back to like 2019 levels. The people who have stayed away are the whales, the VIPs, the rolling chip, high, big money guys. But here's the thing that affects the GGR by a disproportionate amount, but the margins on the mass and premium mass market are about 10 times what they are in the VIP market. And if you're win, that's a problem. By win, I mean win gaming. But if you're Las Vegas Sands, they cater to that mass and premium mass market. And so the part of the market that's struggling isn't really their big business. The part of the market that's recovered is. So I think there's a misperception there. There's also an issue related to some weak property level EBITDA, so property level cash flow in one of their properties, and people saying, "Oh my God, there's a problem." Well, sort of. They're renovating. These companies renovate all the time. So they had, at one point they had 600 keys, rooms out of service. I think last quarter they had 1,500 rooms out of service. In the next 2 quarters, guess what? They'll all be back in service. And it is normal for casinos, for these hotels, which are used very hard. People go and they party, but they want a luxurious experience. They need to be renovated. This is a totally normal thing. It's not weakness in the business or the market. It's a temporary thing that will last another quarter or two. The results out of Singapore, where they have the Marina Bay Sands, have been spectacular. And when I say spectacular, I mean that facility is performing way above pre-COVID levels, and they're doing a huge amount of construction there. So in the meantime, with all of these concerns about the Chinese economy and the weak results at the Londoner in Macau, which again is temporary, that stock has gotten hammered. But I think there's a great opportunity, and people there are spending. They love gambling. They want to go back to it. So we're invested heavily there. I'm also heavily invested in the energy market. That is very much an inflation play. It's very clear to me that Congress is going to overspend. They're still in hugely stimulus territory. They're overspending by trillions of dollars a year. People are very excited, understandably, about the coming election, but I'm sorry to inform everybody, we cannot vote our way out of this problem. Whether you're voting for Team Red or Team Blue, regardless of who wins, I promise you, unfortunately, the government is going to overspend. The budget is not going to come down. The spending is not going to come down. The debt is going to keep increasing. And what that means is more inflation. So what do you do when your fiat currency, just a fancy word for the dollar, is losing purchasing power, right? And you want to stay invested, you go to hard assets. And so for us, that's Bitcoin, gold, energy. And on energy, we're heavy looking at oil and uranium. I'm a big believer in the coming nuclear theory. If basically what people want all over the world is they want a better material quality of life. And the correlation between that and energy usage is right around 100%. And so most of the world, they want to live a more comfortable material life. So that's more energy demand. And remember, everybody's excited about all this, the AI future. Take a look at how much energy these NVIDIA GPUs take up for AI. It's like 5 to 6 times what you would require for a normal data center. And so you have all this demand coming, and we haven't built out the infrastructure. And if you want reliable carbon-free energy, nuclear is the answer. And so we've been buying uranium. And I think the answer there, a lot of times people ask me, why not buy the miners? Because the miners have issues with permitting. Right now, they're buying in the spot market above their contract levels. They're losing money on incremental trades. You have labor costs, you have labor union issues, you could have mine accidents, you could be shut down. But the one thing there's going to be increasing demand for is going to be more energy. And in this case, if you want carbon free, that's going to be nuclear. And so the way we're playing that is buying spot uranium. So yeah, gold, Bitcoin, energy, all great ways to play a dollar that's losing purchasing power. And then, again, high growth stocks, buying companies. And so, think about how recession resistant some of these businesses are, where we're looking at specialty health insurance companies or drug companies for people with cardiology problems. Whether we have a good economy or a bad economy, whether the Fed tightens or loosens, whether we have doves or hawks in DC, I guarantee you people will still have heart problems, and Medicare and Medicaid are still going to pay for it. So these are, some of the businesses we're investing in are high growth, recession resistant businesses. And so if that gives you a sense of how we're thinking about things, I think it's the right way to be positioned, certainly for the next quarter, but I think maybe for the next couple few years as well.
I like that. Thank you for walking us through that. I know it's difficult to share all the specifics in the NDA ones, but you gave us a lot to work with there. And I think we can see some areas that I actually agree with all of those. There's energy. I think that with AI, it's requires so much more energy. So the energy demand is already through the roof. It's going to increase even more, that demand. So we need infrastructure and nuclear. I love that. Nuclear tends to be a great solution for our power demands, as well as Bitcoin mining. And I like that point that you made about the miners. And I think it's important everyone understand that the miners are a business and they have margins compressed. They have their own inflation, higher prices to deal with. And, there are permits, like you said, and they're losing money with the way they're buying the spot uranium. So it's not a direct play on uranium as purchasing the uranium directly. And then the same thing goes for the gold miners and the silver miners. I always tell my people that as well. They can run and they can do well, but if you want to buy the gold for the future, you go to gold directly or silver. And so great points you mentioned there. Now, you mentioned fiat, and I just want to go a little bit into the Bitcoin and fiat, meaning all currencies are declining purchasing power. I mean, I think that's pretty obvious. We look at the Fred chart. I'm surprised they even keep that up still. But
Yeah.
you look back from the 1950s, you're seeing just a cascade going down of the purchasing power. It's declining purchasing power. And that's exactly what inflation is. Our money is losing its value. So your thoughts on Bitcoin? Are you a Bitcoiner and
Oh
you
yeah.
believe that Bitcoin may actually coexist as a future currency besides a global reserve asset?
Yeah, I do believe that. And let's unravel this for people because we're using a lot of financial jargon here. And I think it's really important to speak to people in a way that they can understand and will make sense to them. So first of all, when we talk about fiat currency, all that means is it's a government sponsored currency that is not backed by anything, right? So the dollar, the yen, the euro, the pound, the peseta, the peso, right? All of these currencies are basically issued by governments. And, the days of having your currency backed by gold or silver or some sort of hard asset, that's long gone. In the United States, that was killed by two bullets. One was fired a little over 100 years ago with the creation of the Federal Reserve. The other by President Nixon in 1971 when he took us off the gold standard. And so we went from a situation where the dollar was backed by gold. You could go hand in your dollars and receive a certain amount of gold. Um, Now, if you take a look at your currency, the dollar is backed by the full faith and credit of the United States. Well, we're talking about the credit of an organization that has $35 trillion of on balance sheet debt that is accruing an additional $1 trillion of debt every 3 or 4 months and has over $200 trillion of off balance sheet liabilities. Those are things like pensions, Obamacare, Medicare, Medicaid, Social Security. Those are obligations we've incurred but haven't paid out yet. So the real obligations of the US government are somewhere in the neighborhood of, ready for this, row? $250 billion. That cannot be paid. So therefore, it won't be paid. There is no, people say, well, just tax the billionaires. There is no level of taxation that will produce $250 billion. And so, what we have is, so we're backed by faith and credit. Well, the credit is not good. I don't know how much faith you have, but I have faith in the fact that we're not going to pay back $250 billion. So basically, I've taken a while to explain it, but a fiat currency is any government currency that's not backed by anything. And they can print and create unlimited amounts of it and act like, well, we've just created value. Here, look, here's money. Well, but what can you do with that money? And so what we have is two things. Let's talk about history and where we are right now. History, there have been, I think, 775 fiat currencies in history. They've all gone to zero. The current longest running champion of the fiat world is the British pound. That is approximately 350 years old. Over that time, it's lost 99.5% of its value. At what point can we call that a failure? The number two is the US dollar at around 250 years. That has lost over 96% of its value since 1800 alone and is dropping value pretty quickly. I think, something like 25% over the last 3, 4 years. This is a problem. Um, and so, we often hear people today saying, oh, no, the dollar is strong. right? Look, you can buy more British pounds, you can buy more euros, or we hit parity with some of these currencies. We're up 45, 50% against the yen, depending on the day. So the dollar's strong. Well, so let me ask you, for the people listening to this, um, do you want to be a foreign exchange trader and use your dollars to buy euros or yen or pounds sterling? And if that's the case, yes, the dollar has been strong. Or are you just a US consumer and you want to use your dollars to buy groceries, pay your rent, put gas in your car? Because if that's the case, you're losing purchasing power. And so whether you think the dollar is strong or not depends on whether you're a foreign exchange trader or whether you're just somebody trying to live your life and use dollars to pay for things. And so the key point of all of this is you cannot save in dollars. If you try to save in dollars, you will lose purchasing power every single year. So what do we do? What do we do with that? Right? And these are huge problems. Like even just a 2% inflation rate over a 40-year working life will chew up 55% of the value of your money. That's a really big hit to take for saving in dollars. And so, Ro, it's not so much that I'm thinking to myself, well, Bitcoin's going to take over the world and, gold will be the new currency. It's more a matter of, oh my goodness, this fiat world is collapsing. It's collapsing at an increasing rate. What do we do? And so, you do things like own a home and refinance your mortgage when rates are low. And I did that personally. What people can do now is you can buy and hold gold and Bitcoin and energy. And those are assets that hold their value even when the dollar is losing purchasing power. So what I'm really doing is instead of trying to predict exactly what's going to happen in the world, I'm simply saying, how do I save in a way that preserves purchasing power? Right. And so I'm saving in a way that gets me more dollars. And obviously those dollars may have lower purchasing power, but I'm preserving purchasing power by investing in this way. And between the two of us, I own enough dollars right now to pay my mortgage and my monthly bills. That's it. Right. I don't want to hold anything where the value declines every month.
It's a very smart decision there, very astute observation. And it's not about going all in. And I always tell my people that as well, but it's about a diversified portfolio. But you hold the cash that's losing its value all the time and just enough to meet your obligations, your debt service, and anything you may need for cash flow. But then for saving, it's smarter to hold on to the real assets, have some real estate maybe, and then have some Bitcoin and, gold and all these other elements that tend to be an inflation hedge. And, fiat currency, you made a great point, but wait a minute, Gary, you're telling me you don't sleep great at night knowing that the government backs the US dollar? I
Yeah.
know it's a difficult one, and it's important to be smart about that. And I thank you for that definition, but you don't doesn't make you sleep any better at night, right?
Well, so it's really interesting because people they love asking that question. What keeps you up at night? What allows you to sleep well? And my answer to that is it's not my job to conduct my business in a way that allows me to sleep well. It is my job to figure out everything that can go wrong and put a wall between me and deep knowledge investing subscribers and partners and clients, and put a wall between us and whatever bad thing I think is coming. Um, it has been, as you know, the last few years, a challenging environment, but the reason we've been able to do well is because we've been very flexible. We had people shorting the market in February of 2020 ahead of the COVID lockdowns. We were warning people about non-transitory serious inflation in November of 21 when Treasury Secretary Yellen and Fed Chairman Powell were both saying, oh, it's transitory, it's not a problem. Yeah, it's a problem. And we were telling people what to do. We rolled into 2022 long gold, long Bitcoin, long oil and energy, and short the market ahead of Federal Reserve rate hikes. So being flexible and looking ahead and not worrying about whether you're going to sleep well. That's how we've done well for people. It really is just spending every day thinking, what bad thing is coming? Where can I put a wall or a moat between that bad thing and my people? How do we protect ourselves
Yes. How
from
do we
this?
reduce that risk out there? And it's always about risk adjusted returns and
Yeah.
preventing and saving your capital and for the future and being flexible because things are always changing. I mean, the economic machine has many moving parts and it's geopolitical as well. It's not just about what we have here and domestically. So we need to think in probabilities and we can't predict, but we just think, what are the chances of this occurring or that occurring? And I'd like to say Bitcoin has one of the better asymmetric risk profiles out there. And it's a good bet, in my opinion, for maybe a small percentage of someone's portfolio. It depends on their risk tolerance and volatility. And there's a lot of volatility with that one. But okay, so the Mag 7. Okay, we talked about, I want to bring up the Mag 7 because it's important. It's AI right there in NVIDIA, and you have a lot of other great AI plays. You have Dell and, you know, well, I don't know about SMCI at this point, it's getting a little too erratic, but there's BRT, there's a lot of different plays out there. And so we have healthcare and heart problems. Or unfortunately, I'm not a medical professional, but I think heart disease is like one of the top three or maybe number one cause of death. So that's much needed. It's a necessity to have ways of preventing or helping people with heart problems. And then insurance, obviously, you know, that's another necessity. So the necessities, the real assets, energy, which is increasing in demand, infrastructure. We talked about ways of, you know, helping with the fiat debasement. Mag 7, the AI story. Now, it seems that the earnings were priced for perfection. And so we've had other issues in the market as well. What are your thoughts on the Mag 7 and the AI story?
So I think there are two things that happen. And obviously, those stocks have gotten crushed over a 3 week period. I think we were looking at, Nvidia down almost 20% from where they were 3 weeks ago. Several of these, Tesla is down something almost 20% from where they were 3 weeks ago. This is, as of charts we pulled um, from last Friday, and then they were down a lot more on Monday and recovered on Tuesday. But all of these stocks are down. And so let's talk about, I think there are two things happening, and you've touched on both of them. First of all, these stocks were priced for perfection. We had a lot of stocks with $2 and $3 trillion valuations. And granted, they are great stocks, they're great companies, but they were trading at levels where things needed to be perfect. And guess what? Their results were not perfect. So, you look at, say, Apple, which people love. I understand that. But you've got no revenue growth in the iPhone, and you've had a bunch of quarters of negative unit growth. So they're selling fewer iPhones. That's a problem when you have a multi-trillion-dollar valuation. Google had a generally good quarter, or Alphabet rather. But YouTube, they disappointed. And, we get it. The economy isn't in great shape. People are pulling in some of their advertising expenses. Well, what happens when you're priced for perfection and one of your divisions is not perfect? Then you're not perfect and the stock goes down. Tesla had a bad quarter. Their profits, I think, were down something like 45%. Their registrations in California got hammered. Um, can they pull it out? Sure, that's entirely possible, but it was not a good quarter there. Amazon, again, their Amazon Web Services business, absolutely fantastic, but their retail business, not perfect. And, I think Amazon is a phenomenal business. It's very well run. But again, when you're trading at a multi-trillion-dollar valuation, you need to be perfect. They weren't. So we've had all of that happening. The second thing that's happened is everybody's starting to look and say, wait a minute, these companies are spending tens of billions of dollars a year on capital expenditures to benefit from the coming AI revolution. And, look, is AI going to be a big deal? Yeah, of course it is. But right now, there's a big question on timing. And other than, NVIDIA, people aren't really making money from this. Now, Microsoft, they did come up with a plan. They're collecting a monthly fee from people for, some of their assets. But for most of these companies, AI is still the kind of thing that they're giving away to get attention. There are some places where you can buy AI capabilities, but for the most part, it's still a free product. It hasn't hit prime time yet. And so people are realizing, wait a minute, we're in a weaker economy. People are starting to pull in advertising expenses. Some of these companies underperformed, and they're spending tens of billions of dollars a year on these NVIDIA chips, on the NVIDIA GPUs, thinking we'll build it and they'll come. And people are starting to realize, wait a minute, what's the revenue model here? How are we going to make money? I don't think they're bad businesses, but they might have gotten ahead of themselves a little bit. And here's the real problem. NVIDIA has been selling billions and billions of dollars of GPUs to a very small number of these giant companies. And so if some of these companies were to just cut back their GPU purchases by 10 or 20%, and I'm not saying that's what's going to happen, but that's how precarious this is. NVIDIA, there's a reason they've dropped $1 trillion of market cap. That's people realizing, oh no, right? We've got a huge problem here, because if that growth rate slows or turns negative for 10 minutes, that stock, that it's an amazing company and it's extremely well run, but you end up with a huge valuation problem. And just as a reminder, there is no one stock that has held up the market indexes more this year and in the last year than Nvidia, right? I mean, we went from the Magnificent Seven to like the Terminal Two here. And so we're very, very leveraged. And when I say we're leveraged, I'm talking about the equity indexes. The S&P 500 and the NASDAQ are very, very leveraged to a small number of high growth, mega cap companies, where if they don't have perfect earnings and constantly increasing growth, well, that's going to hammer the indexes. And that's what we've seen for the last few weeks. I don't think they're bad companies, but the valuations are resetting for a different growth rate.
Well said. I think that there is a revaluation going on, and I do think NVIDIA is the king of all of these stocks, and I think it's a top one, but doesn't necessarily mean that the current valuation is a good buy or not. It's just, I think that we have to look at the undercurrents of what's going on in the economy, not only domestically, but globally. And there's a lot going on that can affect this revaluation. I did think that it definitely ran up pretty quickly and maybe went a little ahead of itself for right now. But we have to get into this macroeconomics. We've been touching and sprinkling it around with the fiat and the currency and the necessities and the inflation. So we need to go into that. But I love your thinking with all of this investing. And, the aerospace is another field that I find very fascinating. And I think that has a lot of potential future growth. So you tweeted something, and 5 things to know in investing this week. And you talked about the Bank of England rate cuts. But before all that, I believe we need to get into the yen carry trade. Okay, last Friday, we got a bad jobs report. The unemployment rate shot up 0.8% from the 12-month low of 3.5%. That triggered the SAM rule. Whether you believe that is a predictor of recession or not, it is significant to be up that much in the low to within 12 months. So we're at 4.3%. Then it carried over to the weekend, literally, and we had all this news about the yen carry trade. And Monday morning, maximum fear. Everyone was the market had a really big drop. The VIX shot up significantly. But you called this yen carry trade 2 years ago on a lead lag show. I think it was October 22. And so there's no one better to tell us about what's really going on with this yen carry trade. Tell us about it and tell us what you foresee in the future and if there's potentially more downside.
Sure. So that's a great question, and it's a really important topic to talk about. But first, really important to give proper credit. I was talking about this in October of 22 on the Lead Lag report. That was Michael Guyed who hosted me there. Michael's a great interviewer, and he knows everybody. And it was so kind of him to share his platform with me, just as you are
Michael's
now.
awesome.
Yeah, he's terrific. And Michael, thank you for sharing your platform with me, and Ro, thank you for doing the same right now. And then a couple weeks after that, it was October or November of 22. Mark Rosano and I did a lengthy talk that also is recorded at the New York Alternative Investment Roundtable. And that's when he and I were talking about this. So, we were early on this and right, but here's what's happening. First of all, let's talk about what the carry trade is so we don't confuse people, and then talk about why it's unraveling now, and then what the implications are. So the Bank of Japan, so we had a situation here in the US where we kept interest rates far too low for far too long. The Bank of Japan said, hold my beer. We're going to go absolutely crazy on this. And so they had negative rates for something like 9 years, I think. So try to imagine that, Ro, negative rates, right? Like you bought a bond and you got, instead of getting interest back and the principal, they gave you less money. You were paying them for the purpose of lending them your money. None of this made sense. Negative rates are completely crazy. The Bank of Japan maintained that for years and years. And one of the big problems with too low rates is it means that you don't have to pay anything for ridiculous spending. So if you're the government and you don't have to pay anything on the money you borrow, then money is free. Well, what do? You spend a lot of money. And that's why the Japanese debt to GDP is over 260%. They could afford it because they had negative rates. They weren't really paying anything. I think for a long time, the Japanese 10-year was yielding something like 0.25%. It was something crazy like that. Now, in the meantime, during that same time period, depending on the year and what was going on in the world, the US Treasury, the 10-year, was trading somewhere between 3 and 5%. So that's a big spread. And so what people would do is they would put on what's called the carry trade. And here's the way that would work. They would borrow yen, which is great to do when the cost of borrowing, if you're borrowing 10 years, it's, 25 basis points. If you're borrowing at the overnight rate, it's negative. But basically, you're paying somewhere around zero to borrow that money. And then, what they would do is they would sell Japanese government bonds, buy dollars, and use those dollars to buy US treasuries. And so they could capture a spread, which at times was in the neighborhood of 3-4%. And then they would leverage that up. And that 3-4% was secure. It was free money with one big exception. You were taking currency risk. So as long as rates were roughly flat, right? As long as you didn't have any shocks to the system, currency markets tend to not be that volatile. And people were booking this 3-4% unleveraged and then leveraging it up. And trillions of dollars went into this. Okay, so trillions of dollars were shorting the yen and Japanese government bonds, buying the dollar and US treasuries. And they were making money from that. Well, so here's what happened. A couple years ago, the US Federal Reserve said, yeah, this zero rate is a problem because we have a huge inflation issue. And so the Federal Reserve ran rates up to the current, in the middle of the range is about 5.3%. And that's where we are now. That's where we've been for a little over a year. Well, now that is a really big spread because the US Federal Reserve was at 5.3%. And at the time, the Bank of Japan, pardon me, had negative rates for their overnight rate. So the carry trade went completely crazy. But the issue with that is you had so many people that were selling the yen and buying the dollar that the currency started to move. And they went from 102 yen to the dollar to 140 yen to the dollar. And then it started to approach 150. And people said, well, at 150, the Japanese government, the Bank of Japan will intervene. And guess what? They did, except that didn't work. And we went straight through 150 and into the mid 150s and the high 150s. And remember, as these numbers get higher, what that indicates is a lower value for the yen against the dollar. And so the Bank of Japan then tried defending their currency, and they threw tens of billions of dollars of foreign exchange reserves at defending the yen. Now, what that means is they were selling their foreign exchange reserves and buying the yen. And guess what, Ro? That worked for a day or two. And you can see all these places where they would throw tens of billions of dollars worth of foreign currency reserves at defending the yen. And the exchange rate would come down. It would go in the yen's favor for 24 to 48 hours. And the reason it didn't work long term is because they weren't addressing the underlying problem. What the Japanese government, what the Bank of Japan really needed to do was raise rates, but they couldn't. And the reason they couldn't is because their debt to GDP was 260%. So let's play this out. If they keep rates low, then the yen continues to slide against the dollar. And that's a big problem when you have to import, when you're a small island nation without a lot of natural resources and you have to import all your energy. Energy gets priced in dollars, and boy, is that a big problem when your currency goes from 102 to the dollar to 162 to the dollar. That's a big change. And so that creates problems for Japanese citizens who want to do things like heat their homes or drive a car. Okay, so we say, well, what does the Bank of Japan need to do? They need to raise rates. Well, here's the problem. When your debt to GDP is 260% and you raise rates, your interest expense skyrockets. And so you end up running bigger budget deficits. And the only way that they can address that is to print more yen. Well, what does that lead to? That leads to inflation. And I'm going to reframe inflation because everybody talks about inflation. We sort of understand it, but I want people to think about inflation as a loss of purchasing power, right? Really like frame it in your head in that way. And so basically, the Bank of Japan had a situation where if they did nothing, the yen was going to lose purchasing power, and that's a problem. If they raised rates, then they'd blow out the budget, have to print more yen. That leads to more inflation, which is a loss of purchasing power. Either way, they have a giant problem. So we go back to a couple weeks ago where we got some negative economic news and the employment numbers didn't look so good and the unemployment numbers didn't look so good and the manufacturing numbers didn't look so good. And then Federal Reserve Chairman Jerome Powell stood in front of, this press conference and he said, yeah, we are thinking of lowering rates in September. And everybody said, oh my God, wow, here it comes. After a couple of years, the pivot is finally here, right? We went from higher for longer to sooner rather than later for rate cuts. Well, at the same time, the Bank of Japan, which had taken rates from, I want to say, negative 10% to a reference range of 0 to 0.1%, so they'd gone barely positive, they raised rates to 25%. So what we had was an increase in Japanese overnight rates by about 25 basis points, slightly less. And in the US, everybody's anticipating somewhere between 25 and 50 basis points of cuts. Well, that starts to collapse. Remember, we were talking about that guaranteed 3-4% that people were earning on the carry trade. All of a sudden, not so attractive. And where things get really, really bad is as soon as that happened, the yen strengthened against the dollar. And that makes sense. If you have a higher interest rate on yen and a coming lower interest rate on dollars, the yen will strengthen against the dollar, right? You'll have yield investors who will invest based on that. Well, now you have people who were long the carry trade, and they have two problems. One, their yield is collapsing. They're no longer getting that 3-4%. That spread is being tightened and narrowed by the market. But the place where they really have a problem, remember, they were short the yen and long the dollar, at a point where the yen went from 162 to the dollar to the current 147 to the dollar. These people were getting clipped on both sides. And so they did the only thing they could do, especially in a leverage trade. They started unwinding. Well, what does that mean? They started selling dollars, selling US government treasuries, and they were buying the yen. And so they're unwinding all of this. Well, guess what? There are still trillions of dollars to go. And the next move that the Bank of Japan is going to have to make is going to be a rate hike. The next move the US Federal Reserve is going to have to make is going to be a rate cut. And so when this happens, you end up with a self reinforcing feedback loop. The more people who close out the carry trade, the more strongly the yen will act against the dollar, causing more people to have to unwind the carry trade. So as people unwind, it causes more people to unwind. It's a self-reinforcing feedback loop. That's where we are right now.
Yeah, it's like a snowball effect. As more
Exactly.
happens, it just keeps adding and adding. So, few questions here. This likely will continue. Will it come in stages? If you have any idea on potential timeline of how long do you think these trillions will take to unwind? Do you see a reverse carry trade going on? Is it just an unwinding? Will it reverse? It seems that, we're in an era of fiscal dominance, and the fiscal spending is not ending anytime soon. And like you said earlier, whoever we elect in this year and comes in January will be continuing this fiscal spending. It just has been increasing and doesn't seem to have any end in sight. So that is also inflationary. The money has to come from somewhere. So we have our own issues with that. Now it seems that Powell was a little more dovish and hinted at some type of rate cut in September. Although when we look at the data on paper, doesn't seem like there's much reason for them to cut with their CPI coming down and unemployment still on the lower side, overall. It's not sounding alarms or anything for them yet. So let's say they do cut, and then we have the Bank of Japan increasing, continuing. What do you foresee timeline wise happening with our markets?
Well, first of all, I'm so glad you brought up the issue of fiscal dominance. That's something Lynn Alden's been talking about a lot, and she's been right. The deep
She's
knowledge investing,
fantastic.
yeah, Lynn's terrific. Her work is first rate. Really smart person, great communicator. Love her ideas on this. The deep knowledge investing version of fiscal dominance was a white paper, an ebook that I wrote back in the fourth quarter of 23, so the end of last year, called Counterintuitive Inflation. And basically, what we concluded is basically the Federal Reserve has the same problem the Bank of Japan has. If you don't, if you keep rates high, we have an interest expense problem, and that's going to lead to more money printing to pay the interest expense, and that leads to more inflation. If you cut rates, guess what? That leads to more inflation. So what really has to happen here, if I were Powell, and I'm not, I would not cut rates here. And I understand that's an unpopular take, and it doesn't matter what I think. Nobody's asking me. I wouldn't cut rates here. He's going to. So my opinion on what should happen doesn't matter. We need to deal with the real world, which is what is going to happen. But what really needs to happen here is Congress needs to cut spending. Congress and the White House. That again is not going to happen. So my set of preferences here would be to have Congress cut spending and have the Fed hold the line on rates. Don't hold your breath for either one of those. We're going to get excess spending from Congress. We're going to get rate cuts from the Fed, and we're going to have more inflation. And that is really the conclusion from counterintuitive inflation, or what you and Lynn Alden have referred to as fiscal dominance, which is also a great way of framing it and phrasing it. I like that a lot. Going back to the carry trade, I think you brought up three issues. The first one is, are we looking at an unwind or a reversal? In my opinion, we're looking at an unwind. The reverse carry trade here is people taking off the trade. At the moment, what we still have is the Japanese overnight rate at, 0.25%. When the Federal Reserve cuts, will be around 5%. That's still a pretty big spread. There's still a big positive spread between the US 10-year Treasury and the Japanese government 10-year. I don't think we're anywhere close to people. They're reversing out of the carry trade, but I don't think they're going to do a reverse carry trade where they short the dollar and buy the yen. I think people are just taking off leveraged positions they have where they're losing money. I think we're going to see that continue for a while. You asked if this will happen in stages. I think, yeah, that's definitely the case. There's a great expression, nothing goes to heck in a straight line. Um, the situation is bad. It is really negative. It's very scary. But Ro, look at what we had, and this is an analogy, not the same thing. But look at what we had on Monday. Everybody panicked and said, "Oh no, the economy's falling apart. There's no soft landing," and people just vomited out stocks. And you had Magnificent Seven stocks getting hit by 3, 4, 5, 6% in a day, multi-trillion-dollar stocks. That was a lot of market cap that got lost there. But a lot of it reversed the following day. And then look at yesterday, right? We were up big and closed down big, right? The intraday vol is completely crazy. So yeah, I think this happens in stages. This isn't the kind of thing where you see the unwind happening on a daily basis and you can draw a straight line through it. I think these things always go in fits and starts, and we should expect that. And it would not surprise me, to see the yen continue to strengthen against the dollar, and then something else will happen, and we'll be back above 150 and then back down again. And that's just sort of the nature of these things. Regarding timing, I apologize. I don't have an answer. I don't know. There are two issues there. One is what's the timing on what the Bank of Japan is going to do? And they're not as chatty as our Federal Reserve governors, right? I'm completely convinced that if I wanted to have a meeting of the Federal Reserve Open Market Committee, all I would need to do is put a lectern and a microphone on my driveway. This is a group of people that cannot resist an open microphone. Every week, these people are talking about, their view on policy and the Fed funds rate. Our people love to talk. Okay, fair enough. The Bank of Japan, they're the opposite. They tell people, we will act without warning. We will act erratically. We will not tell you what we're doing. And if you want to short the yen, you can do that, but we're not giving you advance notice when you're about to lose money. So if you're going to short the yen, you better keep your fingers crossed that we don't raise rates on you. And so I don't know how to predict that timing. The other thing is, the credit markets, the bond markets tend to operate until they don't. People talk about the bond vigilantes. It sounds like really cloak and dagger, right? Are you a CIA spy? No, I'm a bond vigilante. But what really happens is the bond vigilantes are just the people who get to the point where they say, I don't want to buy bonds at this price. You need to give me a higher yield or a lower price for it. And history shows that these things tend to be fine until they're not, and they collapse all at once. And getting the timing on that right is very, very difficult. And so, when the Fed lowers rates, they are kicking the can down the road. When Congress continues to overspend, they are kicking the can down the road. When the White House continues to overspend, they are kicking the can down the road. Same thing with the Treasury Department, monetizing everything and shortening the duration on our auctions, meaning we're refinancing more frequently and the size of our auctions are getting bigger. These are all people saying, we're just going to keep doing what we're doing until it breaks. But again, with 35 trillion in on-balance sheet liabilities and $250 billion of on and off balance sheet liabilities, we're just fingers crossed that it doesn't break today. And everybody in Washington, everybody who's responsible for this, they're just going fingers crossed that it doesn't break while they're in office or running for reelection. I don't know when it falls apart. All I can tell you is the current system is not sustainable. I can't give you timing on that. The best I can do is say, if you know it's coming, don't save in dollars, save in Bitcoin, save in gold, save in high, growth stocks where they're recession resistant. And, of course, save in energy. Those are the ways to protect yourself from that. I wish I could give you the timing, but I'd just be making something up.
Okay, well, thank you for your honesty. I appreciate that. Now, regarding this unwinding, you mentioned several trillion, and that's very concerning. That's a great deal of money. Do you think that the stock market is likely to be headed downward? Because that money has to come from somewhere, likely equities, and I mean, of course, other assets as well. But do you think that because you see what's going on and you identify these patterns and you identified them a long time ago, but now it's actually being implemented, do you foresee that the market has greater risk to you to go more on the downside rather to all-time highs in the coming future?
I do. And I'm going to explain why. It's a little convoluted, so stick with me here. One of the places where a lot of people have a misconception is people believe the Federal Reserve sets interest rates across the whole curve, right? Like I run into people who say, well, if the Fed lowers rates, the borrowing costs of the government will go down. Well, maybe. But the real truth of this is the Federal Reserve sets the overnight rate. The market, the bond market, sets the rates for everything else, your 2-year, your 5-year, your 10-year, your 30-year, right? And so we can see a situation where the Federal Reserve might lower the overnight rate, but the yield on the 10-year might go up because people might say, my inflation expectations are now higher, right? So it's really important to understand where the relationships are. Here's what I think happens that pressures US equities. As the Bank of Japan raises rates, which they need to, and as the Federal Reserve lowers rates, which they've said they're going to do, we will see a continued unwind of the carry trade. And as you mentioned, that's trillions of dollars. So here's what happens next. The people who are long the carry trade own US Treasuries. To unwind the carry trade, to reverse that, they're going to have to sell their US Treasuries. Well, what happens then is when you sell a bond, when there's enough selling pressure, the price goes down and the yield is the inverse of that. Investors will demand a higher yield, a higher return to hold those bonds. Well, we just saw in 2022 what happens to high growth stocks when bond yields go up, when the cost of borrowing, when the cost of capital goes up. Well, those stocks don't like it. And so we have a market right now that is very heavily weighted toward high growth technology stocks. Now, again, they are fantastic companies, but when you start to revalue the cost of capital, and that's what happens when people will start to sell, say, the 10-year US Treasury, you end up with equity prices being revalued because you're discounting those future earnings, those future cash flows at a higher rate. So that's a long way of saying 100% unwinding the carry trade can absolutely lead to lower US stock prices.
That's the answer I think we were all looking for, was
Okay.
that, and that's been my presumption as well. So it's a very precarious environment that we're in right now. You know, the fiscal spending, I mean, it's a great term, the fiscal dominance, because the Fed doesn't really have the tools to affect our issues that we have in inflation. You know, lowering, adjusting the rate, it lowers demand and it puts a tightness on the lending. It does affect the supply and the demand of lending, which affects the money creation, since money creation, like by 83% is from lending, not just the Fed. The Fed's not the only printer of money because it's the fractional reserve banking and the money multiplying. But the actual tools from the Fed of the rate policy is a small part. And then we have the balance sheet. And that's another issue. They've been passively letting those assets roll off. Instead of actively selling them, they've been more passive. And also, fiscal and monetary policies should be in alignment, and they certainly aren't with the massive fiscal spending that we have going on, over 34 trillion, over a trillion a year in interest expense. So we ask the rhetorical question. I always say it's rhetorical. How far can they kick the can? They certainly can kick it much longer, even though you and I know it's unsustainable.
Right.
So, do you believe that the Fed could crash the economy? They seem to make policy mistake after policy mistake. What are your thoughts on that?
I, they have a long history of making policy mistakes. In fact, we did this great series of charts on this earlier this year. DKI intern Andrew Brown, I had him go back through for the last few years. He pulled every dot plot that the Fed had, and we tracked where they thought the Fed funds rate would be at the end of the year. And it turns out that generally, with 6 to 12 or 18 months to go, the Federal Reserve is incapable of predicting where the Fed funds rate will be. And here's the crazy thing, that's the one thing they control, right? So the one thing they control, they're not able to predict. And we have the charts showing this. So yeah, the Fed is going to make policy errors. And I think a lot of the issues that we're having right now are not because the Fed funds rate is too high. At the moment, the real rate of interest, which is our Fed funds rate less the inflation rate, is right around 2%. You know, Ro, I don't think people are talking about how the current Fed funds rate is restrictive. I don't think a 2% real rate of interest is draconian. And if you take a look through history, a 5.3% Fed funds rate is not out of line with where we've been historically. So I don't think where we are right now is the problem or the mistake. I think the issue was having zero or near zero rates for the better part of a decade and a half rolling into this. The balance sheet, that in my opinion was a huge error. I get it. You know, during COVID, they wanted to make sure there was enough liquidity to the market, but there's no reason the Federal Reserve should have a $9 trillion balance sheet. Now, to their credit, they've gotten it down a lot since then, but it's still too high. There's no reason they should be doing that. And one of the things that people really like don't know about is I think at the peak, the Fed had something like $2.5 trillion of mortgage-backed securities on their balance sheet. Row, they're not allowed to own mortgage-backed securities. And so people have said to me, well, wait, how can they do the thing they're not allowed to do? And the answer is you can do whatever you want. Someone has to sue you. Right. And that's the thing. They've broken their own rules. They've held trillions of dollars of securities that they shouldn't. And somebody might say, well, you know, great. They kept mortgage rates lower by buying everything. Well, yeah, but that also kept housing prices higher. So when people go to buy a house, right, you know, are they complaining so much about the mortgage rate? The mortgage rates right now are not out of line where they've been historically. People are complaining about the price. So thank the Federal Reserve for that. Yeah, they've made a lot of mistakes. Um, but at the moment, and you know, at the risk of being repetitive on this, I think the biggest error we're facing right now, the biggest source of danger for the US economy and for the fiat dollar going forward is not the Federal Reserve's next mistake, is not whether they hold rates firm or cut by 25 bips or, you know, half a percentage points, 50 basis points. The real issue is continued congressional overspending. Every single administration, every single Congress, whether they're Republicans or Democrats, they take the prior spending level as the baseline and they say, okay, well, you know, we'll pocket this, but now we need more money to spend on everything else. And, you know, whether it's guns and butter or everything, we are way into the bread and circuses part of the show, which is just a fancy way of saying that in ancient Rome, when they were debasing the currency and the economy wasn't good, what did they do? They printed more currency that had less value, handed out bread, and told people to go watch the gladiator fights at the Colosseum and entertained them. That's where we are now. I can't give you the date of where it's going to fall apart, but I think the biggest danger right now is not the Fed, which has been consistently wrong, as you correctly point out. The biggest danger is Congress and the White House.
Well, we want more bread and circuses, Gary.
Well, it is fun, right? Who doesn't love free stuff? But you know what? Let's
Can we
talk
make that
about.
gluten-free bread?
Yeah, we absolutely. We'll call Tracy Schuchart. She's great on that stuff. Her cooking is unbelievable. She keeps posting those great pictures. But you know what? Let's talk about the dangers of free money for a second, because it's really important. There is this sense that all of this spending is good for the poor people, and we're going to tax the rich people and stick it to the rich. And I've got bad news for everybody. The opposite is true. The policies being pursued by the White House and by Congress, which are done in the name of helping the little guy, are actually crushing the poor and the middle class, and they are great for the wealthy. So do you mind if I take a second to explain why and how that works?
Please do.
So look at it from the point of view of a wealthy person. That wealthy person probably owns a home and financed a big mortgage. Well, as the purchasing power of the dollar goes down and asset prices go up, the value of the home goes up, but the monthly mortgage check that you write is worth less and less. The purchasing power you're giving up for writing that check over the next 30 years, that goes down. Wealthy people also have the ability to do things like buy stocks and gold and Bitcoin and uranium and all the things that we talked about that are great ways to protect your home and your portfolio from the lower purchasing power of the dollar. But now let's take a look at what it looks like if you're less affluent, because most of the country is struggling to make ends meet. They're trying to put gas in their car. They're trying to deal with higher home and rent prices, food prices. For the love of God, I do not know where the Bureau of Labor Statistics gets the idea that food inflation is up 1% or 2%. This is my challenge to everyone here. Anyone listening to this, if your grocery bill is up only 1% in the last year, I want to hear from you. You would be the first person to sign on to that challenge. And so there are all these expenses, and all of these policies, these big spending policies, create inflation. And so let's talk about the trickiest, most insidious one. And this is the one that actually makes me angry. Sorry, I know we're supposed to be positive in a podcast, but this one really bothered me. People loved it in COVID when the government handed out free money, right? What we got, $800 checks, $1,600 checks. And people were like, this is fantastic, free money. They were happy. And so somebody listening to this has got to be thinking, well, wait a minute, what's wrong with this Gary guy? Why is he against giving poor people money? Here's the issue. The issue is you gave these people $1,600 once. And that $6 trillion that our Congress and our White House sprayed into the economy caused the inflation that we're seeing now. And so what's the value of that $1,600 if your monthly expenses go up permanently by $100 or $200? If your monthly expenses go up by $200 because of inflation, you got $1,600 once and your annual expenses went up by $2,400. The government is trying to bribe you with your own money while they steal your purchasing power. So it sounds really good to say to people, hey, you're not doing well. I'm the government. I'm going to give you free money. I care about you. But the end result of that is it hurt the people they gave the money to, because they got a one-time check and they got a permanently higher increase in their cost of living. This was insidious to tell people we're going to do this to help you when it really hurt them and left a huge chunk of this country worse off. And that's the thing that bothers me, that they were so deceptive about it, that they said we want to help the poor people, but what they did was they made their lives worse, and they made it harder for these people to afford groceries and to put gas in their car and to heat their homes. And that's the thing that bothers me about it.
It's okay to be angry because it's being truthful about what happened was really harmful for the people. Anytime you increase the money supply as much as you have beyond the productivity and the production of a country, you're gonna have inflation. And increasing the M2 and putting it in the system, I think it was over $5 trillion that was created during COVID. Inflation's going to come. I mean, I have to quote Milton Friedman and the great monetarist. It says, inflation is always and everywhere a monetary phenomenon. So yeah, you give someone money now, a little stimulus check. I think they're doing that in California. You're giving them a little help with something, and you're getting that money from somewhere. The money always comes from somewhere. So you're getting some immediate little bump there, but you're going to be paying in the long run. You always pay. It affects your taxes, your and your inflation, and then all roads lead to monetary destruction. And that's where we're headed at this point. And like you said, fiat is debasing, and that's what we're at now. Inflation is a country issue, and every country has their own issue, and it's related with our currency. But that's what happened then, and we're still working our way through that, and it takes time. Now, regarding rate cuts, you made some great points there, and I just want to add to that. Premature cuts, I'm very concerned with, because we look back to 1970s, and we could have a repeat of that. That if you cut too early, inflation can reignite. And then we have 1970s plus all this massive debt, and our debt to GDP is over 123% right now. And that's very concerning. And they say, like, I think once it goes over 100%, it's the chances of a country doing well, or its currency coming back, is very challenging. And I don't want to be pessimistic here, so I have optimism with that. But also, inflation is underrepresented. And we are looking at, if you look at an alternative shadow inflation, it's more than double the current print. And then you look at the aggregate compounded inflation since 2020, and I'm sure you've seen that truflation, it's in the 20% there. So we know prices are higher. They don't have to tell us it's coming down. And like you said, the 1% grocery bill, food's up only 1.4%. There's no way.
Yeah.
We know prices are up significantly. Some people are saying that their meat is almost double the price. So maybe they're starting to trickle down a little bit, but prices are still higher than pre-COVID. And so, you have all these issues going on. And I want to focus in on this great term that you use called the bifurcated economy. And I think that's a great term to describe this. Can you just tell us a little bit about that?
Yeah, let's talk about that. But first, Ro, this is why you are a fantastic host. I go on and on explaining this stuff for like 10, 15 minutes, and you summarize it in 3 sentences, right? Your version is so much easier to
I
understand
try.
than mine. Your genius is just to sum up
You're too
these
kind. I
complicated
think I'm
things.
too wordy as well, but you're too kind. I appreciate it. Thank you,
No,
Gary.
you're absolutely fantastic. One other thing you said, and I want to emphasize this. Like, if you're listening to this, if you take one thing away from what I'm saying, it's this. I was just talking about being angry about something, and Ro was just talking about being pessimistic about certain things. These are normal, understandable reactions. It is our job to try to find the problems, to try to protect ourselves and our people
Mm-hmm.
from a challenging economic environment. But here is the key thing. I always tell people, no matter how negative I sound, no matter about anything I say that's negative on the dollar or the economy or any of this, don't be sad. Don't be pessimistic. Don't be upset. We're not at Deep Knowledge Investing. Our motto with this stuff is roll with the changes. Yeah, it's a cheesy 80s music reference, but the key thing is there are things that you can do to protect your portfolio, to protect your home, to protect your savings from these things. It just means you need to change strategies. And there are always things that you can do to position yourself to not only be protected from these bad things that have made me angry and Ro pessimistic, but things that you can do to profit from it. And that's our expertise. That's what we do all day, every day. I don't wake up angry and upset and pessimistic. I look at this and I say, well, this is terrible. Let's figure out what we're going to do to make money from it. And there are always things that we can do.
Absolutely. Always opportunities.
That's right. And so reframe it. Reframe your mindset as, all right, I may not like this, but what's the opportunity? And just like, I was telling you earlier, Congress should cut spending, not going to happen. Fed should hold rates, not going to happen. It doesn't matter what I want. It doesn't matter what I think is right or wrong. The only thing that matters is, all right, what's coming next? How do we help people make money from it? And if you're focused on that, you're not sad every day. You're not pessimistic every day. Just be opportunistic and be open to whatever great opportunity there is. There's always a way to do something. And so if you just take one thing away, it's that no matter how bad it is, you can find a way. And if not, you've got people in front of you right now who spend all day looking for those solutions. There are people who can help you with this and who are available to you. You don't have to do it alone. And that's really important. Um, Beyond that, let's talk about a bifurcated economy. I've had some really interesting debates on Twitter or X, Twitter Spaces, and I want to be really careful and very respectful. The people I've had these discussions and debates with are people who I think are smart. I think they're really good economists. They're really good market analysts. They're good strategists. Um, these are smart, well meaning, capable people with whom I occasionally disagree. Just because I disagree with them does not imply a lack of respect for their capabilities or their intellect. These are people I respect, but I disagree with them. And so one of the places where, we've had debate as I've been on some of these, Twitter spaces where people are saying, no, the economy is in great shape. Unemployment is low and GDP is up and inflation is down. And my response is, yeah, sort of. Those are the aggregate numbers, but those aggregate numbers are skewed. And here's what's skewing them. What's skewing them is government spending. So we just saw a 2.8% GDP print. For people who aren't buried in these numbers all the time, that's a good number, right? Getting 2.8% GDP growth, that's a good number. We'd be happy with that. So is that great? No. And here's why. The reason it's not great is because the government is overspending by about $3 trillion a year. And government spending, whether it creates value or not, adds to GDP, right? There's an old sort of economist saw, an economist sort of half of a joke, where if you paid half the country to dig ditches, you pay them $1 trillion, and you pay the other half of the country $1 trillion to fill in those ditches, you've added $2 trillion to GDP, but have you created any value? Obviously, no. The unemployment numbers, the employment numbers, those are constantly revised and not accurate. Even worse, more than 100% of employment growth over the last couple of years have come from either government employment or in sectors that are largely funded by government. We are not seeing growth in the private market economy. And so, and I also, Ro, you made a reference to this earlier, but inflation is understated. I refuse to refer to the CPI, the Consumer Price Index, as inflation. And that's what people typically refer to when they talk about inflation. But, just if you're listening to this, take a look at your household budget. You tell me if your spending, on comparable things is up only 3% this year. I suspect your spending is up more. And so you have government spending that's skewing these numbers, but the private market economy is suffering. And you have a lot of people who are, like one of the reasons the employment numbers are good is we've had no growth in full-time employment. So, Ro, what's happening? You got a lot of people working 2 and 3 jobs. You don't have more people working. You have the same people working more to make ends meet. It's great that people are able to get 2 and 3 jobs, but when people have to work 2 and 3 jobs to pay for food on the table or to pay the rent, they're not doing well. Inflation is a huge tax on the whole country, but it's really a huge tax on the poor. And to say the employment numbers are good when full-time employment isn't growing, when the private sector, the productive private sector, is struggling, and when people have to work 2 and 3 jobs to make ends meet, this is not a strong economy. And so when I say we have a bifurcated economy, I am taking issue with the smart people who I respect who are saying the overall economy looks good. And I'm saying, no, you have huge amounts of government spending and you have a lot of people in the private economy who are struggling and not doing well. And so that split is what I'm referring to when I say bifurcated. It's just a fancy way of saying you have a lot of people not doing well, a small number of people doing very well based on government spending, or they're wealthy and set up well for inflation. And that makes the total numbers look good, but it's not a good economy for a lot of people.
I like that term, and I'm going to take it another step further. I like to say that the data seems to be fabricated. It's always in how they collect the data and how they calculate it. And I've had some great economists here on the show recently, and repeats. Dr. EJ Antony was just here the other day, and yeah, the numbers are fake. They're calculated to fit their narratives, and bifurcated is a very nice way of saying that the headlines do not match the details under the hood. So unemployment numbers actually should be double what they currently are. They could easily be in the eights. Labor force participation rate is still lower than pre-COVID. Where are all these people? They left the workforce. They're not claiming the unemployment. Then you have the great gig economy. Welcome to the gig economy, where everyone has these part-time jobs. So there are a lot of issues in the labor market, and it's very likely to continue trickling up that number significantly. We have fake jobs that were reported, plus big government. About half of the jobs that were reported were in government. So we have more government jobs. Add to that fiscal spending that we keep talking about, this massive debt that we have, and which is inflationary as well. So we have underreported CPI, we have higher unemployment, and the numbers getting revised lower. We're seeing half the jobs reported in Q4 of 23 were fake. They weren't even there. So they really assumed a lot, that the startups and the businesses that were closing, they assumed the startups would last, and actually a lot of them failed. And there's so much to talk about in the business world as well. We could just digress. We could just go into all these different tangents. But yes, the GDP, excellent point, Gary. You know, they came out with a revised estimate for the quarter, and they had 2.8% from the 2.5. Oh, really? It's massive government spending, and the transfers. Transfers are actually the consumer spending. So when you see consumer spending, it's actually a lot of that is government transfers. So there you again, you have government spending. It's even greater than we thought. So it's bloating the GDP, and it's crowding out, and it's disguising a private sector hardship. And I know we've been tweeting about it, a stealth recession. And for my manufacturing business, I think that recession has been in manufacturing. It's been a contraction with new orders. Started probably the end of quarter 1 of this year, beginning of quarter 2, March, April. We started seeing a real shift occur significantly, but it started last year, started slowing down, but we could really see it this year. ZERP is always bad policy. Historically, the rates aren't as high, and there are always opportunities. And that's why you and I, here we are, delivering the truth beyond the headlines and revealing the bifurcated economy, because with that information, we're able to make better decisions that seize those opportunities, because there's plenty of opportunities out there. Just because the yen carry trade is going on doesn't mean there aren't opportunities.
That's right.
And the ones you mentioned, the real assets and all the other ones, great ideas. This DKI is like a diamond in the rough there.
Thank you.
This has been truly, really amazing speaking with you. Also, I want you to share with our audience how they can read more about DKI and follow you.
Thank you so much, Ro. So if you want to follow me on Twitter or X, it's at Gary_Brode, Brode. Also, please feel free to go to the website. It's deepknowledgeinvesting.com. And you can sign up. We have, for individuals, we have very low premium subscription rates. Those people get the 5 things early, and my stock picks, the things that I'm buying and selling, the new research reports coming out. But even if you're not ready for that and you want to get to know us first, there is a free option that you can sign up for. All you have to do is put in your name and email, and you'll start to see some of the macro content we put out is not paywalled. The 5 things we make available to free subscribers on Wednesdays. So there's plenty of value there. And, what I hope is that you'll go check it out, sign up for a free subscription. And hopefully if you like what you see, you'll be open to a premium subscription and be part of the family later on this year. Thank you.
Thank you, Gary. And we're definitely going to have to do this again. Check in with you with your valuable insights. Thank you.
Ro, thank you so much for hosting me. Always great talking to you. I love your takes on things, and can't wait for the next conversation.
Likewise.